We have Srivatsa, this fund manager and EVP at UTI AMC, joining us on the show. Hi, Srivatsa. Good to be speaking with you. Let's begin by discussing the market outlook because, of course, there's recently been a lot of volatility on account of this entire, election outcome and verdict expectations. But going forward, what is your, market outlook? Have we made the top for the year, or there's a lot more room to this rally?
Yeah, hi, good afternoon. Well, in terms of the market outlook, we have had a very stellar run in the last couple of years. I think the Indian markets have been amongst the best performing markets globally. And this is led by a decent amount of earning upgrades as well as, stability in the overall economy and also in the corporate side. Going forward, we do believe that the market valuation is at around 20-21 times 1 year forward. And of course, the mid cap and the small cap are trading at a significant premium to the large caps. In this kind of a scenario, we really don't see much scope of the PE getting re-rated. But yes, we still are hopeful of a kind of a double-digit earning growth over the next 2 years for the Nifty as such. So the market performance would more or less be in line with the earnings growth. And so far, we have seen a very decent earnings growth in the last 18 months, and we still see that momentum continuing on the back of a reasonably strong domestic economy, mild inflation, and healthy outlook on the earnings side, which should drive the market going ahead in the next couple of years.
And Mr. Srivatsa, where is it that you see that earnings upside coming in?
If I look at the sectors, I think the banking still continues to be a good source of earnings growth. They have contributed in a big way in the last couple of years. We still see that continuing. Capital goods has seen a very stellar earnings growth, and we see no reason why it should slow down. That should also continue. Apart from that, healthcare and FMCG also should contribute. FMCG has been a drag that should also contribute. And the other one that I'm quite positive on is commodities, because that has seen a very sharp run up in the prices, which will start reflecting in the coming quarters.
Okay, point taken. That's the view coming in. But what's the view on private banking names particularly? Because, of course, this is one space all the mutual funds and institutionals have been very overweight on, and they've been massively underperforming. What have you been doing about your private financial holdings? Are you trimming it down, or are you looking at adding it just because the underperformance is expected to reverse soon?
Yeah, so we have been overweight on private banks for the last 1 year, and that's hurt us in the short run, especially in the last 6 months. However, we still continue to be very positive on private banks in spite of the underperformance, because the valuations are very reasonable vis-a-vis the market. So they are still trading at, it's one of the very few sectors trading at valuations below, say, a 19 level or even 16 levels. Number two is that still we see scope of earnings growth, and credit outlook still remains very good in terms of credit growth, and credit quality also looks to be quite favorable. So one factor which has impacted the private sector banks is that there has been issues with some of the large scale banks, specific to those banks, which has kind of pulled down the valuations. As we see those concerns easing, we should start seeing the outperformance of the private sector banks in the coming quarters. So we continue to be very positive, because on a valuation, especially on a relative valuation vis-a-vis the market, private bank looks to be very attractive.
Okay, that's the take coming in some of the private banking names. Srivatsa, else is the opportunity right now? I mean, should one be looking at bottom-up stories, or would you say go with the momentum, more of the same is the kind of strategy that would work?
Yeah, specifically in terms of sectors, I did talk about private bank where there are reasonably good opportunities. The other sectors that I'm liking is healthcare, specifically on the export-oriented side. So there has been a kind of a very decent outlook on the US generics. I think the prices have stabilized. So the export-oriented healthcare companies is one where I see decent amount of opportunity, both in terms of valuations and growth outlook. And the third sector where it's more of a contra call is FMCG, where valuations are in line with probably a 3 or 5 year average. But we do believe that the worst is over in terms of the demand. So that's a very good play on the rural demand, and margins have been fairly resilient there. So these are the pockets of opportunities that I see in terms of outlook going ahead.
in your first answer, you talked about how the valuations of small cap, mid cap are trading at a much higher premium versus the large caps. In this context, are you looking at deploying more purely in large caps and trimming position in mid cap, small cap, or what's the strategy around that? And also, I wanted a word regarding these public sector entities.
Specifically come to mid and small caps, I think as an index, they are trading at higher levels. And it also implies that probably the top quartile is trading at a far, far higher levels than the overall market or the index. But given that the universe of mid and small cap is large, I still able to find some opportunities within the mid and small caps. But I don't take a strategy to move from mid to large. But yes, between the three in terms of valuation, large caps offer a very decent amount of comfort in terms of valuation. In terms of index, yes, mid and small cap don't offer that level. But having said that, since the universe is big for mid and small cap, there are opportunities which a fund manager can evaluate within the mid and small cap index. And in terms of PSUs, I think they've had a very stellar run in the last 3 years because of the change in the sentiment. And yes, there has also been a very good improvement in the overall business environment. So, say, for example, in defense, there has been a sea change in the overall improvement, which has led to a massive amount of earnings growth as well as cash flows. And the valuation multiples have also gone up significantly in the last couple of years. So if I look at PSU, I think it's a bit difficult for me to put it in one basket and say that they are cheap or they are expensive. One has to look on a case to case basis. So still, I would say probably PSU banks still look good, and some of the PSU names on the gas space, in the energy space, still looks good. If I were to classify it sector wise, but on the capital goods side, on the defense side, and other sectors, the PSU is expensive and far, far higher than the private sector counterparts.
Okay.
Right.
Okay, point taken. Srivatsa, on that note, we let you go. Thanks so much for making time and speaking with us today about a whole host of sectors that you like and the market outlook.
If you like this video, then like, share and subscribe to ET Now.